The stock market is a dynamic space where investors buy and sell shares representing ownership in companies. Understanding the types of stocks is fundamental for any investor, whether beginner or experienced. Stocks can be categorized in multiple ways, each providing a distinct perspective on the opportunities and risks involved. Common stocks. These are the most widely known type of stocks. When you own common stock, you own a piece of the company and can vote at shareholder meetings. Common shareholders are eligible for dividends if the company chooses to distribute profits, but dividends are not guaranteed. Importantly, if a company goes bankrupt, common stockholders receive payouts after all debts and preferred stock are settled, which makes them the last in line. Preferred stocks. Preferred stockholders have priority over common stockholders when it comes to dividends and asset distribution if the company is liquidated. Dividends for preferred stocks are often fixed and paid out regularly, making them appealing to investors who seek stable income. However, preferred stockholders usually don't have voting rights in company decisions. Growth stocks. These stocks belong to companies expected to grow at an above-average rate compared to other firms. Growth stocks often reinvest profits into expansion rather than pay dividends, resulting in potential higher capital gains but minimal income for shareholders. Typically, technology and innovative companies dominate this category. Value stocks. Value stocks represent companies that appear undervalued compared to their fundamentals, such as earnings or sales. These stocks may belong to established companies facing temporary setbacks or operating in mature industries. Investors in value stocks seek to profit when the market eventually recognizes the company's true worth. Blue chip stocks. Blue chip stocks are shares of established, financially stable companies with a history of reliable performance and dividend payments. These companies are leaders in their respective industries, like Apple, Coca-Cola, or Johnson & Johnson. Blue chip stocks are typically less volatile and are favored by conservative investors. Penny stocks. Penny stocks refer to shares that trade at a low price, usually below $5 per share, and tend to belong to small or highly speculative companies. They are known for high volatility and risk, but also the possibility of substantial gains. Penny stocks are generally traded over the counter, OTC, rather than on major exchanges. Income stocks. Companies that pay regular and higher than average dividends are classified as income stocks. These are often in sectors such as utilities, real estate, and consumer staples. Income stocks attract investors looking for steady passive revenue, such as retirees. Cyclical versus non-cyclical stocks. Cyclical stocks belong to businesses whose performance is closely tied to the economic cycle, such as automobile and construction industries. Non-cyclical or defensive stocks operate in sectors that remain stable during economic downturns, like healthcare and food production. Small cap, mid cap, and large cap stocks. Based on market capitalization, stocks are categorized as small cap, mid cap, or large cap. Small cap stocks represent newer or smaller companies with potential for growth, but increased risk. Mid-cap stocks balance growth and stability, while large-cap stocks are for mature companies with less growth risk but greater stability. By knowing these categories and how each type operates, investors can build portfolios matched to their goals, risk tolerance, and investment strategies. Diversification across different types of stocks is key for managing risk and maximizing potential returns in the ever-evolving world of equities.